This is Scott Snyder, and I'm here with Ian Aguilar, my business partner at Mellon Money Management.
Hey guys.
A financial planning firm here in Nocatee. Today we're doing our Dude, Where's My Money videos. And today's video is going to center on the current investment trends and really looking at, starting with today, last week, are stocks still overheated after last week's 5% drop?
I mean, for so many of our clients, I thought it was so hard to sell when we were at the bottom, right? When we had that first huge drop, for me, it was almost too easy to just be like, let's just stick tight, right? The harder question is, now that we've come back to levels where we're pretty close, if nothing else, we're back to where we were at the end of 2019.
Right.
It's a much tougher question to answer. To be honest, now that you've come out the back end of all of what's kind of floating out there as far as possible bad news for the market, I think people are looking for an excuse for something bad to happen to a certain extent.
We're waiting for the next shoe to drop, right? I mean, yeah. And I tend to be in that camp, quite frankly. I think we are due for another 10 to 20% drop before the year end. Some things that stood out to me as I was doing some reading over the weekend. Investors, I think were quick to latch on to the first signs of hope when they saw that 2.5 million jobs added report for the May jobs number. Mm-hmm. But what isn't being reported enough on is that there was basically the unemployment data was misleading from the Bureau of Labor Statistics. And they've been getting it wrong for the last 2 months. They mistakenly counted 4.9 million people as being employed when in fact they were unemployed. So
a lot. I think there's that, and then there's also the other flip side of it is that you're looking at it from the rational number and the numbers perspective, but not everyone sees that, right? I think sometimes I was watching CNBC at one point last week, and Mohamed El-Erian came on, and he was talking about, it's almost a win-win for the stock market in the sense that it's either, if you look through all the bad data and you hope that you're getting this massive recovery on the back end of it, that the stock market is going to continue with what it was doing before all this stuff happened. Or even if bad data does come through, you're hoping that the Fed is going to backstop it. It even came out today, right, with some more news around purchasing corporate debt. There's certain arguments to be had on the other end of it too, but definitely when you look at the numbers, it's hard to see how well we come out of this.
Yeah. Well, I mean, think about it. We've had the Federal Reserve and the government provide a lot of unprecedented stimulus and a backstop, if you will. But at the same time, I mean, you've got companies and small businesses like restaurants and the service industry that are operating at 50% capacity. You can only do that for so long before there's long-term ramifications of it, or at least a very prolonged recovery, in my opinion. And that's, I think, the issue that I'm coming to grips with is, we're getting adjusted to a new normal, but that new normal still means less growth.
Yep.
Doesn't it?
Think about it, right? I mean, PE ratios aren't the end all be all, but prices, if they're still around the same where they were last year, but earnings are definitely going down. I think that they said, again, PE ratios are an imperfect measure, yeah. but with the fact that they're trading at 22 times forward earnings makes it the highest valuation since mid-2001.
Right. We all know what happened then, the dot-com crash.
Yeah.
So
I think that we're a little hot and heavy. I know for us, we've been doing some things for our clients, especially in some instances more so than others, but it's a hot market, to say the least.
Yeah, a little bit overbought at the moment, but at the same time, you can also look. The other argument is look at Apple and Google and Amazon and these bigger tech companies are really, they make up 20% of the S&P 500, and they're obviously doing pretty well. So maybe that's what's really making the markets look better than the rest of America. What way we're feeling when it comes to the smaller businesses. So the you know at the same on the other side of that, the other worry is these small businesses could trickle up into the economy if enough fail. So
yeah. I mean, it's an interesting time. You see, when you look at the ticker for the stock markets, you look at the different sectors. It's when it's a down day, sometimes the only green one you see is tech.
yeah, think about that. 5 companies make up 20% of the S&P 500. Like, that's enormous. That's never.
And it's only getting bigger. And it's only getting bigger, right?
So, I mean, I think the bottom line is that if you're at or near retirement, you probably want to be in a more defensive stance with your investments. But for those that are at the accumulation stage, I don't think you really need to be worrying day to day or month to month what the markets are doing. Just keep saving and allocate appropriately.
Sure. Yeah. No, I think that's the most logical thing. I mean, there's so much that's up in the air. But when you look at those big companies, I know we were talking about one just the other day, right? Amazon is just continuing to push through all this. And even last week when the rest of the market was down, they were pushing up.
Yeah, Amazon's been crushing it. They're up 36% annualized since 1997, which is, I'm glad I own it for my own portfolio. By the way, we're not endorsing as an investment in this video, but Amazon obviously has been crushing it, and a lot of it has been attributed to what's known as the flywheel business strategy. Are you familiar with that at all?
Yeah. I mean, I've read a book at one point, or read a book. I listened to them on audiobooks, but it's your general strategy in terms of one business basically keeps propelling on the other, and you just keep adding to the flywheel, and eventually it goes so fast, and the business, there's different arms.
1,000 small kind of results aimed in the same direction with all these business segments that they have. And the other thing they're doing is using big data and AI and machine learning to really allow them to respond to this pandemic a lot more swiftly than other companies have been. I mean, think about all the data they've been able to collect just from people buying stuff on Amazon.
Yeah, it's almost. How do you feel about that? I sometimes go back and forth on what my thoughts are in terms of how much data they
makes my life easier. I'm like, a big deal,
Yeah, that's right. Exactly.
I really don't have much to hide. It's when it starts getting a little creepy and invasive that way, like on Facebook, that's when it bothers me a little bit more. But if I'm purchasing something and that's what they're trying to make the user experience better, I have no problem with that.
Yeah, which is what makes them so successful, especially in this time, right?
Yeah. Yep. So, what do you think about the current retail business trends? There was a piece I read in Fortune called "Misery at the Mall," and as you would expect, the winners lately have been Amazon, Microsoft, Apple. But there was one surprising company in there. Do you have a guess as to who it might be?
I mean, those three are all electronic facing. Best Buy, I guess. I don't know.
No, but they've actually done okay. They weren't in this report, but it was actually Lululemon. Surprising.
Yeah, it's that e-commerce. I mean, if you're able to drive that home, that's what's going to keep you afloat during these tough times.
Yep. And some of the losers were Gap, Nordstrom's, Macy's, and Chico's, all down about 50% or more on their revenue.
I mean, that's exactly, again, furthering our point. People people aren't going shopping for clothes on the weekend. I mean, it's just not happening.
Nordstrom's has a pretty strong online presence. I was a little bit surprised to see them in there. Macy's, Gap. I mean, Gap, geez, they're not even paying the rent.
I know, but so I think for there's so many things that are particular. At least for me, I speak from personal. I can't shop close in online. I got to go in store.
That's fair. Yeah. Some things I get online, but my father-in-law, he's one of those that he has to go in person to get something.
Yeah. And so if enough people feel that way, it's an issue.
Yeah. But the biggest surprises I think failures were the ones that went bankrupt, Neiman Marcus and J. Crew. As somebody who shops at J. Crew, I was a little bit disappointed to see that one.
Yeah. I think there's certain names that you're more surprised than by others. J. Crew is definitely one of them you're more surprised with.
Yeah. But again, it goes back to this e-commerce thing. So I think when you're looking at stocks and people that are, doing DIYers, you got to look to the companies that are doing more of the online retail model and keeping the retail center kind of side of it a little bit more bare bones.
Yeah, and there might even be some, I haven't looked into it, but there could be some opportunities down the road from a value perspective if any of these companies have enough cash flow and cash on the sidelines to weather the storm.
Yeah, TJ Maxx comes to mind for me.
Yeah.
So moving on to our next point, something that I think has been kind of coming up lately, I think, as you look at what the markets have been doing is investor envy. Do you have any thoughts on, people and looking at the benchmark as a way to measure their success? Is there any fallacy in that?
I think there's a lot of things that you can poke holes at here. The one that really gets me is, your majority of your index funds aren't going to beat the index because there's certain fees, there's trading aspects, there's just a whole plethora of things, but they're also probably the closest thing to the index because they're index funds at the end of the day, but they're always going to be below the index. They're never going to be market beaters. Now you're starting to see some smart beta ETFs that can add a little bit here and there. But even then, oftentimes you'll find those not performing to what some back test might suggest.
Sure.
What do you think?
So what I think really, is going on is the financial services industry is trying to create all these benchmarks and to some degree to get people to move their money around because they're, constantly feeling the envy of, well, I'm not beating the benchmark. And, I kind of use this analogy. If you tell somebody they made 12% and you just said that, they would be very happy. But if you tell them everybody else made 14%, well, they're going to be pretty upset. So
Sure.
that's sort of what's going on with these benchmarks is people, it's kind of creating this fallacy and that you should be beating it when really you should be more focused as an investor on what your goals and objectives are and the downside risks and minimizing those sort of factors, especially as you're nearing retirement.
Yep.
The money for, paying for college. So capital preservation is certainly a part of the equation and that will, if you're in that mode of capital preservation, it's going to be less than the benchmark. But if it's a return that is sustainable and able to help you meet your goals and objectives, who cares?
Right. And that's the nice thing about those indices too, is that there's that diversification, but you also get a certain level of predictability just because over the long, how these indices will trend in the long term, right?
Yep.
Better, more so than some one-off investments.
Yeah, I mean, they're nice to have as a reference point, but that's it.
Yeah.
So our last point here today is about the current college crisis. I watched a video on Anderson Cooper. He had interviewed, I can't remember the guy's name, but I know you watched the video too. What were your thoughts on what they deemed as a college crisis and what is that college crisis right now?
Yeah, and I wrote an article on this on our blog, and it kind of speaks to you a little bit more that we'll link in the notes, but it just so much stuff was happening before all the pandemic in terms of college, and that there was a lot of colleges, I think, on the bottom end that were getting squeezed, and we're struggling to find talent enough to pay the bills, because the smaller schools really do rely on butts in the seats, really. And now that people are raising the question of, does it make sense to actually pay such a high cost for college? Those colleges are really hurting. So that's where the college crisis arises.
Yeah. Well, if you're going to be forced to take classes online, like, why should you be paying full sticker price?
And that's the question everyone's asking, and it's causing some of the smaller colleges, I think, to scramble, and even some of the bigger colleges. Man, you look at some of the losses that these schools have, and it is jaw dropping. I think I saw Michigan had one estimate of possibly losing $1 billion. It's like one school, Michigan University. It's like,
oh, as an Ohio State fan, that's okay by me.
No.
No, I don't wish that on my worst enemy. And, I think we're certainly in an interesting period of time for colleges, but they're going to have to adapt. They're going to have to start, thinking about, these places not being such feeling like a resort all the time, with these bigger universities.
Yeah. Colleges are going to come out of this looking a little bit different, just from an experience standpoint. If nothing else, they're going to have to think on their feet for once. They've had the luxury of being able to bump prices above and beyond everyone else over the last 20, 30, 50 years. And I think this is the first time that they're going to get a little pushback.
Yeah, it's nice, I think.
Yeah, a little refreshing.
Well, thank you for tuning in today. This wraps up our latest episode of Dude, Where's My Money? Stay tuned for future content.
Thanks, guys.